Thank you. Nice to be here.
You were early in arguing for Powell's renomination. What do you think he needs to accomplish this morning?
Not too much. I think if he just doesn't step into any mud puddles, and he's too smart to do that. He's going to be pressed on a number of things. I'm sure he's going to be pressed, for example, on whether the Fed's going to start raising interest rates in March. He can't answer that now. He can dance around it, and he will dance around it. He's good at that.
Sherrod Brown has already said this morning that Powell needs to restore trust in the Fed after the ethics controversy. Says that trading by some Fed officials, in Brown's words, confirmed the worst suspicions about government. What do you make of that line of questioning? Is it material to the Fed right now?
Well, I'm afraid it is. I wish it wasn't. I'm afraid it is. The Fed operates on trust. People have to trust the Fed, not just to be non-political, which it is, but to be sort of beyond reproach. And I think those trading incidents, scandals, whatever you want to call them, have not done the institution any good. And the person that can put a stop to it, really, is Jay Powell. So I think first of all, I think he should be asked about it. And secondly, I think he should answer it as forthrightly as he can. Now, a little footnote to that is I wouldn't be a bit surprised if Fed lawyers are drafting new regulations right as we speak, and they're not finished yet. So he may not be able to give a definitive answer, but I think he needs to come down firmly on the notion that any even hint that Fed officials are trading for their own profit is unacceptable.
I'm sure there's going to be quite a bit of questioning around that. But Alan, just to go back to inflation for a minute, maybe he can't talk about rate hikes specifically in front of the Senate today, but how does he convince lawmakers that the Fed is not behind the curve? And I ask that given the fact that just yesterday, former New York Fed President Bill Dudley published another op-ed. He said that the Fed has been operating in a, quote, Alice in Wonderland fantasy, that it's made 4 crucial mistakes to allow inflation to soar, and that it's going to result in more interest rate hikes than the market now expects. So maybe he can't get into the specifics about near-term policy, but how does he calm those jitters?
Well, I think he has to talk anti-inflation in a serious way. Maybe he doesn't have to quite sound like the second coming of Paul Volcker, but something a little bit close to that. I wouldn't go as far as my friend Bill Dudley did. But look, the Fed is behind the curve. What a lot of people didn't realize, only people that really pay attention to the details, was that the Fed's new operating procedures announced in August of 20 basically guaranteed it would be behind the curve, because the Fed said it's not going to act in advance on a forecast. It wants to see inflation go up. Well, it has, and it went up a lot faster than just about anybody, including the Fed, thought it would. And now they're certainly behind the curve. And Powell shouldn't try to deny that, but talk about how they'll get ahead of the curve, so to speak, in the coming months.
How much of that will hinge on the reaction in the bond market, and specifically the yield curve? We've got taper on the table, we've got rate hikes on the table, and now we have a potential shrinking of the balance sheet on the table as well. How much will the Fed need to take its signal from the bond market?
Not too much, I would say. A lot of us economists that aren't bond traders, all of us economists are not bond traders, have been looking at bond yields for a while now and scratching our heads about why they're so low. There are lots and lots of reasons why they should be higher, starting with the deficit, continuing with inflation, adding in now Fed tightening on the very near-term horizon. I think it's amazing that they've gone up a bit, but I think it's amazing they're still as low as they are in real terms, for example. Never mind the short-term burst of inflation, but just as you look at long-term inflation, likelihood of long-term inflation, in real terms, still negative. So I don't think the Fed wants to put too much store in that, and certainly not let its behavior be dictated by the bond market.